Ticker symbol IT is up over 32% in the past year. And today we'll be looking at an established firm with consistent growth, which is a very predictable market leader, which has solid fundamentals, rising efficiency ratios, and it is at the forefront of the data and information sector, which is something that is very trendy nowadays. So today we'll be looking at Gartner, a research and consulting company. In their annual report, they say that they deliver actionable, objective insights that allow companies to make smarter decisions and deliver stronger performance. Basically, they do consulting, but a very specific sort of consulting, which is highly data-driven. And this, of course, provides a lot more value to customers as the insights are more personalized and they're based on actual information, which means that they're actionable, as the title says. So basically, Gartner's mission is to help companies manage their information and transform all this information into insights, which will actually allow management to make the best decisions they can and run the companies the way they have to be run. So they have three main sectors. The first one is research, where companies will be paying subscription fees in order to access a lot of valuable content, from research to benchmarks and to unlimited access to experts all around the world. A fun fact about this sector is that around 70% of the contracts are multi-year, and most of these contracts are renewed every time that they expired. Now, their second offering is conferences, where Gartner will organize and give conferences for different specific needs. The main reason why these conferences have so much push is because a lot of companies want all their management, upper management, middle management, to get the necessary skills and be aligned on how to manage their firms through uncertainty, how to navigate risks properly, and how to prioritize investments to get the most out of every buck that they're investing. And finally, solution number 3, which is the more commoditized solution in the market, is their consulting services, where of course they serve higher executives such as CEOs, CTOs, or CFOs to drive technology-related initiatives and hence drive business impact. And we can see this just by looking at their financial analysis, where they have an astonishing 30% return on capital employed, which is a lot higher than our threshold of 15%. Then they have a very high interest coverage ratio of 9 times, where we usually prefer this to be above 10 times, but since Gartner's revenue is so consistent, this shouldn't be an issue. Next, they have a strong cash conversion of 91% and a profit margin of 68%, which overall leads their operating margin to be 14%, just under our threshold of 15%, but we will have to see if this has any negative impacts. Because the fact is that Gartner has been growing very consistently for as long as we can see. Their revenues and their gross profit have been increasing consistently, but there is one minor concern where their net margin has actually been decreasing for their past quarters. One thing to add to this, however, is that this seems to have happened in the past. If we look at the change from March 2022 all the way up to September 2022, their net margin also decreased, but then it got back up again, and it seems like it's always dancing in between 14 to 17%. We can see that their efficiency ratios are extremely consistent, but that if we look at them from a long-term perspective, they have been generally rising, which is a very good sign. Now, one thing that I'm not quite a big fan of is all their leverage. Of course, their total assets are above their total liabilities, which is okay. However, I'm not sure why a consulting and professional services company would require so much leverage. This can actually pressure them in times of high interest rates, which of course are extremely rare, and right now we're in an environment where interest rates are decreasing. However, you can never be too sure what will happen with interest rates. Now, when we look into their fundamental analysis, this company gets an almost perfect score. They get a 7.5 out of 8 because first of all, they have low liability risk with a 9 times interest coverage ratio. They have a very solid balance sheet as they can pay all their short-term liabilities only by using their current assets. Then they're very, very consistent with their cash flows, and they're actually doing a great job of growing this organically. This, of course, is thanks to their organic revenue growth. And by organic, of course, we mean that they're able to grow these two without needing acquisitions or mergers. Now, this company is great as it conducts heavy share buybacks, which means that it's able to decrease its shares outstanding over time and increase the earnings per share in an inorganic fashion. But the two most important points of the slide, at least for me, are first of all their pricing power and second of all their existing moat or competitive advantage. When we look at their pricing power, this to me is defined as companies which are able to increase their prices without losing too many customers. To me, Gartner actually meets this criteria, as since they have such a unique value proposition and they have such an established brand name, companies are willing to pay higher prices for their services and their offerings than for any other competitors. Additionally, in many of these cases, companies are getting so much value from their analytics and are able to do so much improvement in their company just discovering information that they didn't know they had, that any price increases that Gartner can realize will be a lot lower than the potential value and potential improvements that the company can make just from using their services. Now, moving on to their competitive advantage, the main thing here is that Gartner has been in business for a very long time and they have extremely strong relationships with a lot of different companies, which creates this sort of stability and predictability in the stock's financials, because a lot of the revenue is recurring revenue, and this is one of the purest forms of competitive advantage. That means that competitors will have to work 2 times or 3 times better than Gartner in order to actually steal the customers from them. Additionally, the part of their business that gives access to a live expert network is a very strong value proposition, which not a lot of consulting and research companies offer. And I believe that this enough can guarantee a sort of higher value perception than for any of the other competitors, allowing them to retain their customers for a longer time. But now the one thing that I didn't like about this company is that they don't pay dividends, and a company like this, which is, we can call it mature and very predictable, should be able to pay some dividends in order to return more value to their shareholders. Now, when we look at this company's historic PE ratio evolution, this may suggest that the company is currently overvalued, as it holds a PE ratio above 48 times when the average is closer to around 35 times. Additionally, when we look at their free cash flow yield of 2.53%, this is lower than the 3% long-term inflation rate, also suggesting that the stock is trading at an overvalued price. However, this will make sense because such a high-quality company is likely to trade at higher multiples. Now, risks and possible challenges, I do not see many, as their revenues are very consistent. However, I could see a worsening competitive landscape because a lot of the new technologies that are arising, this can allow a lot of newer, leaner companies to adapt technologies which Gartner might take longer to adapt to. The second one is performance or not meeting performance objectives, and this can be because of 2 things. First of all, because they're at a very high valuation, meaning that any returns from now onwards will probably be affected by this, as the company's price does not have a lot of room forward to run. And the second one is related to the way they manage their free cash flow. Since they don't pay out dividends, they have to rely on share buybacks in order to generate this sort of value. And a lot of companies actually mismanage this because instead of doing share buybacks when the company is undervalued, they do it when the company is overvalued, which does not generate value and instead destroys it. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong moat, consistent predictable cash flows, and a higher return on capital employed, which would actually deem this as a very good company and a good investment. However, they have uncertain earnings growth and earnings potential. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.